Hello, everybody, and welcome. My name is Tom Lyons, and I am responsible for communications and content here at GenTwo. And I've also been the host of our global AMC Summit week this week. Today is a session I've been looking forward to for quite a long time because it's a real technical deep dive into the subject of AMCs. That's why we call it a masterclass. And I've brought two masters from GenTwo with me today to discuss it. What we're going to be doing is we've put together a case study. It's a synthetic case study, and then Matthew will talk about that in more detail. But it really reflects a real world use case in a fairly complex AMC issuance. And we're going to discuss what the case is, and then we're going to do a kind of a deep dive in the form of frequently asked questions on structuring and legal topics. And after that, we'll have time for a Q&A. If you do have questions, please use the Q&A function that you'll find generally at the bottom of your screen. We will do our best to get to all of those questions at the end. I think a fair amount of your questions may be anticipated by our FAQ format. Others might not be, so feel free to ask what you want. And if you have any other issues, technical issues, and want to communicate with us, you can put that also in the Q&A, and Stephanie will be monitoring those. So that's it from my side. Again, welcome. And right now, I'd like to introduce my team. Matthew, why don't we start with you and just say a quick hello and who you are and what you're doing here every day at GenTwo.
Good, thanks, Tom. So my name is Matthew McShane. Senior structure at GenTwo, and what that means is I'm involved in all of the products which we issue, from the kind of design ideation phase to taking those products to issuance and getting them live on the market. We're involved closely when it comes to the term sheet creation, when it comes to hedging the products, when it comes to working with the paying agent and directors to try and get your idea live and to get an investment structure out there into the world. That's a bit who I am. I have been here for almost 3 years, seeing a lot of cool and crazy stuff come through the GenTwo pipeline. We'll talk a little bit about what we see in the slides. Originally from Northern Ireland, so hence the funny accent. I apologize. And yeah, background in asset management, but excited to talk today and convey some of the passion that we have for the products that we set up with you.
Yeah, we can check on that.
Pierric?
Hi everyone, my name is Pierric Tsien. I'm from the product legal team of GenTwo. Joined a bit more than 2 years ago now. I have the typical legal background in Switzerland, working in a big four law firm and then in-house. Essentially, working here to support the effort of the team, essentially on the investment to the underlying of the product. So reviewing the agreements and making sure that the documents and all the transactions are where it should be and how it should be. And yeah, looking forward for this session. Thank you for having me.
Okay, so I'm going to ask Pierric to start us off by doing something extremely legal and legalistic. Is we're going to start off with a disclaimer, and it's actually an important one. So here we go. So Pierric, you want to take us through this?
Yeah, sure. So this conversation is intended solely for the information of the participants. So this information is not intended to be legal or any investment or advice, nor legal or tax opinion, and should not be regarded as either legal or investment advice or legal or a tax opinion. There are no representation or warranties made as to the accuracy or substantive adequacy of any information provided in this conversation. If you would like further information, you should contact your own advisors for any specific advice on legal, investment, or tax issues. This is the formal part.
Yes, and I'd just like to add that that's really important, actually, because GenTwo, we're not a regulated entity. That's on purpose. We're an infrastructure provider, and we cannot provide any of this kind of advice. And I say that because people often ask in the Q&A specific questions as to their particular case, which is fine. I understand that. But it may be the case that we cannot answer such a question into specifics. We're happy to talk about what we know, but we can't give anything that touches on a real case. Great. Okay. Well, with that in mind, then I think we'll start off, and I'm going to hand over the con to Matthew, who's going to start up talking about the structuring angle. And if I'm not mistaken, Matthew, we're going to talk about the product first.
Yes, exactly. Thanks for the disclaimer. So as was mentioned, we here have a kind of dummy product, let's call it, in order to present to you some of the intricacies and some of the characteristics of the typical AMC that we see come through our pipeline. What we've done here is we've tried to focus on what we call internally a hybrid AMC, which is an AMC featuring underlyings which are both liquid and private. So by private market underlyings, I mean anything like private debt or private equity, which is not directly clearable by any clearing institution, may not have an ISIN, and would be a direct investment typically. The liquid part is, of course, liquid assets which are cleared by a clearing institution, would have an ISIN and could be traded on a regular basis via custodian account. So the reason we've tried to do this, the reason we've chosen this example is because we see this as a very interesting case. We see it as a case which is highly sought after in the market. We see it as a very cool use of the AMC structure and the AMC strategy. It's not often that you see a structure in which you can combine such a wide variety of different types of underlying assets and still have investors participate in that whole basket. So we've tried to create a kind of template for everyone to try and make it interesting and to try and showcase a bit what an AMC does and what a cool AMC might do. And again, this we love. This is our life. This we do every day, and we hope that we can convey some of that interesting stuff to during this. So the multi-strategy growth and income AMC is our dummy AMC that we've created. It will have private equity, private debt, and liquid bankable assets underlying in a basket, as I've mentioned, issued from a PCC structure in Guernsey. It's open-ended and it's cleared and settled by a 6. And it's open for institutional and professional investors only. And as I said, the key I want people to see here is that there is this wide variety of underlying assets. We've got private equity, we've got private debt, we've got the liquid assets. You can go to the next slide, Tom. With every product, there's an investment strategy. I've written a vague template of an investment strategy here with some of the philosophy behind it, as I've touched upon already. We, as a structuring team, we create a term sheet. The term sheet is the governing document for the product. The term sheet is the document which allows us to open the product with 6 and allows for the product, the AMC to be issued, and then allows also for note holders or potential note holders to buy the ISIN and to buy into the product. In the AMC, we define the investment strategy and talk a bit about what will be included. What we think is typically good and what we see as a benefit is that we keep the investment strategy vague enough that it can be dynamic and include a wide variety of different underlying assets, but also have some specific information so that the investor or the note holder may know exactly what they're getting themselves into. So that's just a bit of the strategy and philosophy. Next slide. And here we have a brief overview of the investment universe, again included in every term sheet. This, again, I would like to just highlight this is a total template, total dummy structure here that we have come up with. This is not a real product, but this is kind of generally what we would see for a hybrid structure. You have a certain proportion that is private equity, certain private debt, certain liquid assets, and a certain proportion which is cash. And the reason why we have cash is obviously to just provide a cash buffer, but obviously you don't want cash sitting there for too long. So what works best is to put as much of your cash as possible into liquid underlyings to allow for some maybe money market instruments with fixed income yields alongside the private equity and private debt, which is not bankable and not tradable and typically not liquid. So this is a little bit how it would look like in terms of what's actually going to happen in the underlying of the structure. Next slide. And here you have a diagram. So we create these diagrams for every product. This diagram is reviewed and approved by all of the stakeholders in every AMC. And the idea here is to give a visual conception of what the product or the AMC will look like, how the money is going to flow, what documents are involved, what fees are involved, and so on. And here, as you can see, you have an issuer in the middle, which has a paying agent, allowing investors to place orders from their custodian banks to the paying agent, allowing then the product manager to instruct investment in private debt, private equity, or the liquid stuff. What you would have at the liquid side in the bankables would be a power of attorney with the custodian account, allowing for the AMC product manager to make those daily investment decisions to allow for them to maximize the performance of the liquid underlyings, all of course with the end objective of maximizing returns for investors. Like so. Next slide. And here again, a little bit of a template fee structure. What we do is we listen closely to the clients or the product manager to understand what fees do you want, what fees are adequate, what fees would your investors be okay with, what fees is sort of market rate for the type of strategy you're executing. These are template or dummy fees, but this is what we see in the market as being kind of generally acceptable. You always have a management fee. Typically, you have an administration fee. You might have a setup fee to cover setup costs, and then a performance fee. Here we've gone for a simple quarterly observed high watermark performance fee with a hurdle rate applied, and then there is of course the bid offer spread on secondary market trades. So this is a general structure of the fees, but as I said, this is a dynamic conversation that we have with the involved parties to understand what fees do you want and what fees would be acceptable. They are then approved by the paying agent, who will typically, if the fees are far above market, might push back, but typically whatever fees the manager needs will be acceptable for their investors, then we can include in the product. Next slide. A little bit of a wordy slide, but here just a bit of background on the structural features and competitive advantages of the AMC structure. So the AMC, the actively managed certificate, is of course actively managed. It does not have there is not the same regulatory burden as for a traditional fund. It is not considered a collective investment scheme by CISA. It is not directly authorized, the AMC itself, by FINMA, and doesn't require any fund registration. That means of course the bureaucracy is a lot lower, the documentation requirement is a lot lower, the time to market can then be a lot faster, and really allow the strategy manager to focus on executing a high quality strategy. We try to optimize for time to market and push things out as quickly as we can in order for managers to capture a market opportunity that they see. We try to make the AMCs as flexible as possible so they can, as I said, hold a wide variety of underlying assets. And importantly, we usually issue the AMCs in a PCC structure, meaning that they are segregated from other structures, meaning that the assets and liabilities are themselves ring-fenced from other AMCs, giving some protection for the investors in there. Every product has an ISIN. Every ISIN is opened on the Swiss Clearing Institution 6, which is a robust and sophisticated clearing system, which gives a lot of comfort. That means it's typically bookable by other clearing institutions, via the custodian bank of note holders. As I mentioned, we try to have a dynamic and rich mandate to allow for product managers to really in real time capture market opportunities and capture alpha. Funds are a lot more expensive, as many of you will know. We try to keep costs low and try to keep things affordable, which is obviously important for strategies which maybe have an assets under management on the lower side. And the fee engineering is completely bespoke, and we have a discussion with the managers on how to organize this. There's not the typical 220 build for every AMC. It's completely tailored to whatever makes most sense for the strategy and for the market and for the investors. So next slide. Right into some questions. So as Tom mentioned, we have some FAQs that come up again and again from clients, from stakeholders, from parties in the structure, and we have distilled a few of those questions down for you to kind of discuss what we typically see come up as we see. Just we imagine that any new product manager or new investor might have the same questions. The first question is, what exactly is an AMC and how does it differ from a traditional fund? An actively managed certificate is I would summarize it in saying that it is a financial structure under which you have a basket of underlying assets, and the structure itself tracks the performance of those underlying assets. So an investor or a note holder in the certificate can himself or herself directly participate in the performance of that basket of underlying assets. The note holder does not directly own the underlying assets, but is a participant in the performance. So if it goes up, your value goes up. If it goes down, your value goes down. You directly track it. It is considered a debt instrument usually in the Swiss context, and it is regulated by Swiss law. However, it is not, the AMC is, as I said, not directly governed by FINMA or by CISA, allowing it to be a lot more flexible, quicker, easy, more dynamic. The traditional fund, of course, has a lot more of a regulatory burden, is more expensive, and typically takes much longer time to set up. Therefore, it's a little bit less dynamic. And one of the key advantages of an AMC would be that it's because of that dynamism and speed to market, it allows investors to capture immediately the market opportunity that's in front of them. Whereas a fund structure, because it takes longer and it's harder to change and less dynamic, it's easy to miss the market opportunities in our dynamic and fast-paced market. So that's a little bit about an AMC and how it differs from a traditional fund. Of course, there are advantages and disadvantages to both in that a fund allows for greater protection because of that regulatory setup. The AMC is typically really only suitable for sophisticated investors, professional investors, unless there is the requisite base prospectus set up to allow for retail investment. But for those type of investors who want to capture the market at a fast pace, the AMC is a really powerful and unique structure, and something that we're really passionate about and we see a lot of demand for in the market. Next question. So you saw earlier we have this structure with this dummy AMC with private equity and private debt in the mix as well as the liquid underlyings. The question here is, how does it work to add new non-bankable assets to the AMC and what approvals are required? By non-bankable, we mean those non-tradable or illiquid or private market assets. So that would be the private debt and the private equity. The approvals that are required are basically, we would need to see the documentation surrounding the new investment. We would need to see probably the loan agreement or the shareholder agreement, and the paying agent and directors would need to approve this. If everything is clean and we have everything available, then we can add a new non-bankable asset in, let's say, 10 business days. However, if it's a more complex structure or there is maybe the documentation is not fully clean or readily available, it'll obviously take longer. But the point I want to make here is that we can always add new assets to the structure. We can be dynamic and seek market opportunities and bring them in to an existing AMC. We try to build at the design phase, build the AMC to be flexible and to allow it to capture market even after it's issued. So we could bring new assets in. If there are changes that need to be made to the term sheet or to the product, there may be a corporate action instruction required to allow investors to be informed of the change. But typically we try to capture all of that in the design phase, so there's no need for corporate action. But so that's generally a bit of the process about how we get that approved. Go to the next slide. Yes. So can the AMC truly hold private equity, private debt, and listed assets within the same wrapper? Well, the answer is clearly yes. As a lot of our clients will tell you, we have a large number of hybrid products which hold a wide variety of different types of underlyings. So this is absolutely possible, and again, kind of a unique a feature of an actively managed certificate, and that you can really buy into a wide variety of different underlyings and participate in the advantages that those different underlyings have. For example, you have maybe a fixed income component with the private debt underlying. You will also be able to then participate in the shareholder performance, the share performance of the private equity underlying, and then you can, let's say, participate in the performance of the equity or the fixed income or the bonds or the ETFs of the listed underlyings. So this is a very powerful thing, and we can always work with this and make sure that it's flexible and dynamic and allow for new opportunities to be captured within the same structure. Next slide, please. Why include a liquid sleeve alongside private assets? Well, the liquid sleeve, of course, offers you liquidity in order to satisfy any life cycle events that might come up. This could be redemptions, investors trying to redeem from the product at any point. The liquid sleeve would allow you to create the liquidity to allow you to satisfy those secondary market redemptions. There may also be recurring fees on the product, and having the capacity to create liquidity at the product level in order to fund the fees is always a useful and powerful thing. But I would say in general, and importantly, there is a balancing of the structure. It allows for diversification into different types of assets, and it allows for different types of income streams to be included in the structure at the same time. I'll give you an example. What we see come up again and again is if a manager wants to create an AMC which maybe targets one particular industry or one particular investment theme, for example, a healthcare focused AMC. With this hybrid structure, you could focus on buying private equity in healthcare companies, giving loans by private debt to healthcare companies, and buying liquid ETFs or liquid equities in the healthcare industry. This would be a fully focused, industry-focused product with a wide variety of different types of income streams from that one industry, which I think is a very powerful tool and really gives a lot of leverage and a lot of it's a very interesting way of getting into the market. Next slide, please. How are the liquid assets held, and what custodial safeguards are in place? Well, the liquid assets are held at a custodian. So we would have a custodian account set up at a custodian either we already work with or a new one. We have a wide variety of approved parties that we work with already who offer the same services. Some of them have advantages in that they are specialized in specific types of underlying assets. Some the costs are the advantage, some time to opening. But in general, it's always setting up a custodian account. The custodian has to be somehow regulated and authorized in its country of domicile. And so those safeguards are in place. And as I mentioned earlier, there is always a limited power of attorney between the custodian account and the product manager to allow the product manager to make those daily investment decisions and to maximize the performance of the product. So that's a bit about the safeguards. Can the investment strategy be updated or expanded after the AMC is live? Again, this is positive. We have many examples of when a product manager set up a product and then a year later, 2 years later, found that there was this amazing market opportunity that they wanted to get involved in, be it something liquid or illiquid, and they needed to change the strategy, they needed to change the investment universe, and so they come to us and ask us, can we change it? If it's already included in the term sheet, then it's very easy. We can do a very simple change. If it's not, and it's something that might have an adverse effect on the risk of the product, then we may need to do a corporate action in which we notify note holders of the product that there's a change ongoing. But this is all fairly standard. And again, this is a process which can take anything from 5 to 15 business days. Whereas if we were dealing with the traditional fund structure, this would be much more complicated and time-consuming and expensive for an actively managed certificate, that is a totally easy possibility to come in and change the strategy of your product which you have set up, and capture new investment opportunities that maybe didn't exist when you set it up. Next slide. Then, what regulatory framework governs the AMC and what investor protections exist? The key component and the key thing to remember about an AMC is that the AMC itself is not directly regulated by CISA or by FINMA. There usually are regulated parties in the structure. Typically, if there is a liquid aspect, there would be a regulated product manager. But in general, the AMC itself is not directly regulated. The issuer is authorized in Guernsey by the Guernsey Financial Services Commission, and the paying agent, the custodian, may be regulated wherever they are. But the AMC is not itself regulated, which is of course different from a fund. It's typically there is a fund regulation and fund reporting that needs to be produced for a fund. What there is, as I mentioned earlier, the PCC structure. So the protected cell is set up, which is completely segregated from other protected cells opened by other AMCs. So there's a ring fencing of the assets and liabilities of a particular product within that structure, which allows a level of protection for the investors. But it's important to note that the reason why AMCs are so dynamic, one of the reasons they're so dynamic and quick to set up, is because there is a lighter regulatory burden. The downsides to that are, of course, that we can only offer to professional and institutional investors. But for those types of investors, this is a very powerful type of structure.
Okay. Well, thanks a lot, Matthew. That was very interesting. And I think the last question, the regulatory question, gives us a good bridge into the second part, which is going to be the legal thing, the legal aspects of this AMC issuance. And for that, we're going to turn to Pierric. And again, we're going to work in this FAQ fashion. So actually, Pierric, I will just hit the button and over to you. Here's your first question.
Thank you very much, Tom. So what are the core transaction scenarios for a private equity direct investment? I guess the first scenario that comes to mind is that of a primary investment, i.e. a capital increase. So that is where the target company would issue and allot new shares to the issuer, so the SPV, which then by doing so would inject fresh capital into the business of the target company. So usually a capital increase is preferred when the target needs growth financing. And the second scenario would be that of a secondary transaction, i.e. Share purchase. That would be where the issuer acquires existing shares from one or several selling shareholders, or also from the target itself, in the case of treasury shares. It's less common, but we see that actually more and more. Secondary purchase usually provide for liquidity to existing shareholders that are exiting their investments, or that are willing to offload some of their shares. In this scenario, there's no dilution to the cap table. So the choice actually depends largely on the investment thesis and the company capital needs and sellers' expectations. Next question, please. Yeah. How does each scenario drive the contractual package? That's a very important question here, because each scenario has its own set of documents and requirements. In a primary investment, the core document would typically be a subscription agreement, together with an updated shareholders agreement and an updated articles of association. Whereas in a secondary context, the core document would be a share purchase agreement between the seller and the buyer, and usually with an accession right to a shareholders agreement if that is existing. Next question, please. Which share class are typically being considered, and why does the class matter beyond pricing? the class of shares is determined by the investment stage and the negotiated terms. So usually, typically, there's the common or the ordinary shares, which carry standard and voting and economic rights. The preference shares or the preferred stock, they call it, typically carry liquidation preference, anti-dilution protection, and sometimes enhanced dividend rights. On the other hand, participation certificates may offer economic rights, but typically without any voting power, so there's no right attached to vote. Of course, there's also like the series or like the different designation that comes with them, like Series A, Series B, Series C, which reflects successive funding rounds with usually different terms that are attached to each of these series, which need to be reviewed later on. So the question of which class is aligning most to the interest of the investors. It depends largely on their expectation in terms of return, and in terms of governance requirements. We can think also like if some access to information rights would be required, and anticipating the proceed that would be expected in case of a liquidity event. Next question, please. What additional documents are being reviewed before proceeding with an investment? So we've already indicated the usual principal documents. Now we're discussing some of the additional documents. Well, of course, a comprehensive documentation is essential, and what we would typically see would be a shareholder register and a capitalization table, essentially to confirm the current ownership and to align the numbers on the current round of investment. The Articles of Association would be the next document, essentially to understand the governance rights that are attached to each class of shares that we mentioned before, and to identify any potential consents and waivers that would be required. This is important in the context of flagging of the items that would need to be delivered before closing. Usually there will be the review of the business plan, essentially to see the investment thesis and the projections that are coming along. And we would usually see the bank details confirmation to ensure a fluid transfer of the funds, and lastly, a tax memorandum in order to evaluate the tax structuring and its implications. Of course, like if there is an inconsistent or incomplete set of documents, it can create some delays, and sometimes can be a sign on the side of the target company that there can be some concerns that can be raised. Next question, please. What are the most common transaction blockers you see early? It's essential to identify these transaction blockers because they can really delay the closing of a transaction, or even prevent a transaction from happening. So what we would see usually is where the titles to the share would be incomplete or contested, or if we would identify that the share capital is not entirely paid, or if there's some encumbrances on the shares that are in existence. What we would typically see also is the transfer restriction in the Articles of Association or the shareholders agreement, or if there's some requirement for the board or for the shareholders to pass on some resolutions or give their consent to the transfer or to the issuance of the new shares. Typically also is are the preemption rights and the right of first offer and right of first refusal. Usually there would need to be some waivers that should be obtained in time, meaning before the closing. Another usual transaction blocker is if there are any litigation that are ongoing, that would largely delay depending on the outcome or the expectation. Also, we have the regulatory approvals that need to be obtained in time. We see also some issue around tax if there are some unresolved tax liabilities or if there's any pending tax audits. And yeah, if there are some instruments that the company has issued, the target company would have issued, and that would have some impact on the cap table, meaning, for example, some convertibles, some warrants, or some options. All of these will need to be resolved before closing. So again, this list is not exhaustive, but these items should be flagged and resolved before the signing, or at least addressed as a condition precedent to the closing. Next slide, please. Is a board resolution or shareholder resolution required? Are amendment to the Articles of Association or shareholders agreement needed? Well, it's entirely dependent on the jurisdiction and on the situation of the company. But what we see is that in most jurisdictions, a capital increase requires a shareholder resolution, usually with a qualified majority, and potentially an amendment to the Articles of Association to reflect the new share capital. In the context of a secondary, meaning share transfer, this would require usually the approval of the board, especially if there's some transfer restriction in the Articles of Association. But in both cases, any new investor joining the shareholder base will typically be required to enter into an adherence to the existing shareholders agreement, and potentially having some revised terms regarding the governance if they are changed materially.
Sorry, did I jump ahead?
Yeah.
What did I hit?
Yeah, that's fine.
Is that the next one? Good. Sorry about that. I hit my mouse.
Exactly. No worries. It's all good. So that was, yeah. Are there some particular classes of asset which draw further scrutiny? Yes, there are. Usually there would be real estate and intellectual property. These are the assets that would come to mind. Essentially, the nature of these rights would require some further review and require appropriate protection. So, for example, if the target holds significant real estate, we would need to review the title and confirm that there's no encumbrance and that the value is actually verified by the third party valuation provider. And if the target company is or its value is actually driven by intellectual property, essentially patent, trademark, or trade secret software, their ownership would have to be confirmed, as with their freedom to operate, and the assignment or the licensing. Essentially, actually, the licensing arrangement would have to be reviewed so that there's no issues on this one. Typically, these assets would be this kind of asset would typically be covered in specific representation and warranties in the transaction document. And any issue on their title, or is there any contest or any potential risk, this will need to be flagged, and it will need to be addressed early on. And unfortunately, this could create some delay in the overall transaction. So this is why it's important to address these items quite early in the process. Next question, please.
Now it's right.
Indeed, thank you. What would be standard representation and warranties? Typically, the representation and warranties would be, and here I would give a non-exhaustive list. We'll just provide what would be some of the basics. And I have to pause here and say that any list would actually be dependent on the specifics of the investment and the finding throughout the review. So usually the representation warranties would be around the title to the shares, and if they have been validly issued, that the company has no insolvency or bankruptcy proceedings, that the parties have authority to enter the transaction, and that there are no required third-party consents that have not been obtained beforehand. Usually, we would see the absence of material litigation or proceedings. Of course, from a corporate governance perspective, and up-to-date and complete corporate books and records would be required to have, and of course, like a true and fair financial statements. Another reps and warranties that is typical would be the timely findings of the tax returns and the payment of the tax obligations. And depending, as we just seen, depending on the type of assets, a valid title to these assets would be required. Of course, lastly, compliance with all applicable laws would also be required as representation warranties. Thank you very much for this.
Well, thank you very much, Pierric, and thank you very much, Matthew. I think that brings us to the end of the formal part of this presentation. I hope it's been useful for all of you. Like I said, it's, at least from the point of view of a poor communications guy like myself, fairly technical, but you know, we do see a lot of these typical types of products these days. I think the hybrid structures are particularly interesting, and that's a growing part of our business as far as I understand it. So we do hope that this was a good, a useful, and really a deep dive into this subject. We do have time for questions. So we had a whole bunch, we had almost 8 or 10 questions before that have been whittled down to 4. So I'm assuming that for the people who withdrew their questions, that the question was answered during the FAQ part, which is also great. But yeah, let's go through the rest of these, and I will just start with the first one. It says here from anonymous attendee, I understand AMCs are not necessarily qualifying as a traditional fund, some more specifically an AIF, but can well and quickly see itself add this regulatory burden. So the regulation might be coming. How to make sure that you stay outside the AIF territory? Who wants to take that one?
I can comment on this. Maybe Pierric, you have something to add afterwards. But it's a good question. It's something that we are to be constantly aware of and make sure that we stay within the boundaries of what is an AMC and what doesn't fall under a more complicated or more cumbersome financial structure. In our term sheets, we clearly state at the very top of the term sheet that this is not considered a collective pooled investment scheme by CISA. That is not considered a FINMA regulated product. And we need to be very clear and very deliberate that we can only distribute the products, the AMCs, to professional and institutional investors, that retail investors can't be involved. Throughout the term sheet, there are also terms which clarify some of the mechanics are specific to AMCs and are not fund-related mechanics. And we get regular updates from council as to how compliant we are with the regulations regarding AMCs. So in general, I would say we work on that via our term sheets. We make the structure as explicit as possible, and we try to make it clear to any investor or note holder buying the product, or FINMA, or anyone else who might be reading the term sheet, that this is in fact an AMC and not a collective investment vehicle and should not be considered a fund.
Great. Next one. What FINMA or other license do you need to issue and manage AMCs?
I can also touch upon that. It depends. So it depends on a few different variables. And let me try to use the structure that we presented as an example. If there is a liquid component of a structure, meaning that there is a custodian account with a limited power of attorney, allowing the product manager to trade on a daily basis certain liquid underlyings, then there needs to be a certain level of regulation from a governing body, be it FINMA in Switzerland or FCA in the UK or wherever it may be. If there is no dynamic discretionary component, so let's say it's just buying private debt or private equity that means there's no discretionary component to the strategy, then there is no need for any regulation for the product manager. So they can actually buy those assets without needing a license. So that's possible. Now, when it comes to if there isn't a required license, what exactly license do you need? It varies, of course, from country to country. FINMA has a long list of different types of license, be it asset manager and so on. Typically, if you have acquired any FINMA license related to making investment decisions, this is adequate. And so we have clients with FINMA licenses of all different types. And as long as there is a definition which allows you to make investment decisions, then we can accept it. But as I said, if there is no liquid component in the structure, there is actually no need for a license.
Okay, are AMC's CLNs that are issued before considered as liquid assets in a new AMC? That's an interesting one.
It's a good question, and I think that's interesting because it highlights part of the advantage of setting up an AMC, in that as you saw on our slides, every AMC that comes through our platform is opened on SIX with a Swiss ISIN. And that means it's tradable and clearable by the international clearing systems. That, by definition, makes it a liquid asset. So any AMC or CLN that we work on, that we help to issue, is by definition a liquid asset and could be considered such. Now, I can't speak for every structuring provider or every issuer, whether all of them actually assign an ISIN or open them on a clearing system. But it's pretty common that AMCs and CLNs would have an ISIN and would be clearable, and so yes, would be considered a liquid asset.
Great. Okay, here's one maybe for Pierric from Armando. Which regulation applies to the loan agreement between the AMC and the third party? What is the interest rate? I guess that depends, but who wants that one? Nobody? Pierric? Yeah.
Yeah, well, I'm happy to jump in this one. I'm not quite sure I understand entirely the question, but between the loan agreement and the AMC and the third party, that would be entirely dependent on the trust of the party. Typically, there would be the regulation at the side of the borrower, so meaning the third party company. And then what would be the interest rate? Usually there would be some components that would be applicable in the jurisdiction. Probably there can be some market specifics in there, and usually it's so long as it is market standard and that there's no related party component. It's probably there's more freedom, but as long as there is a related party, meaning a common shareholder or like a common entity in the setup, then there would be some limitation in the interest rate that could be provided. Usually, each government or each administration from each jurisdiction are actually issuing some notice or some regulation on what would be the admissible interest rate in the context of a related party, for example. Yeah, hope I have helped address this question.
I believe so. We have two more. It looks like the next one is, if we're dealing with a private equity AMC, does the manager need to be regulated or not?
Can address it. So if it's a private equity underlying, that means that it's a non-discretionary strategy. So you would have an AMC on a particular private equity investment on a particular shareholder agreement. That means that there's no actual discretionary component. There's no day trading. There's no custodian account, which means that the product manager does not need to be regulated. The only reason you would need a regulation or a license would be if there is a discretionary active managed component of the strategy. So if you're just raising money and buying private equity, there's no license required.
Excellent, thanks. Next one is, I believe we're saying here, is there a bid-ask spread for liquid bankable asset AMC, or is it possible to buy at the net asset value price once a day? So talking about secondary markets here, I guess.
Yep. Well, the bid-ask is applied to every secondary market trade. If you raise subscriptions in the primary market, i.e. before the product is issued, then there is no spread applied to that trade. But every trade in the secondary market will have a bid-ask spread of up to 1% on the trade. So basically, you buy at NAV on the particular trade date, and then there is the spread on top of the NAV, which gives you the basically the trade price. Yeah, I hope that answers.
Okay, it does indeed. All right, there's one more which I'm going to take myself at the risk of it's the simplest question, but also a bit of a tricky one. So there are so many issuer providers in Switzerland for AMCs. What would be considered when choosing the right issuer? Well, what can I say? I guess you want to look for track record, you want to look for expertise, and you may definitely want to look for a company named GenTwo. And I don't know if any guys have anything else to add to that without getting me in too much trouble.
I think you've summed it up well. I think there are indeed a lot of providers. We pride ourselves in the quality of service and the speed to market. And we pride ourselves in listening to our clients and trying to set up the structure which works best for them. So choose the right issuer for yourself and your strategy, obviously, but we do take a lot of pride in the quality of service that we deliver.
Okay, thanks. I hope you all don't mind a little bit of an advertisement at the end of this. Look, gentlemen, this was really, really good. We are at the end of the hour, so I'm going to cut it off here. Matthew, Pierric, thank you very, very much. As a reminder, we'll be getting, you'll all be getting links to the videos. You'll all be getting our report. There'll also be contact information in there. You're always very welcome to get in touch with us directly if you have further questions. If you're interested in, obviously, in issuing an AMC or exploring other products, please do. And yeah, thank you very much. I hope to see some, if not many, if not potentially all of you tomorrow at the AMC Creator session, or potentially tomorrow morning at the Breakfast with Swiss Quote. So goodbye, everyone, and thanks.
Thank you.